Good morning and welcome to the Balance Commercial Property Trust Limited Q4 2023 NAV update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Christine Cantrell, Head of Investment Trust Sales. Good morning.
Thanks very much, and we're delighted to be here. I'm just going to introduce the experts today. So we have Richard Kirby, who's the lead manager of Balance Commercial Property Trust. We have Daniel Woolsgrove, the deputy, and we have Scott McRae, who's essentially in charge of the financials, etc. So we have everybody here to answer your questions, and we're very keen to hear from you towards the end, and I'll just moderate the questions when they come in. So with that, I'll hand over to Richard to kick off the slides.
Thanks very much, Christine, and good morning, everyone. This is the first time we've used the Investor Meet format, so we welcome a wider audience of shareholders and prospective shareholders. And this morning we want to run through our Q4 activity and results. And Q4 was an active quarter for BCPT. It was positive, and we were active in both the capital markets with the sale of 3 assets, and we undertook and completed some significant asset management activity within the portfolio, all of which we will cover during the course of this presentation. The format this morning and the running order, I'll first of all hand over to Dan Woolsgrove, who will set the scene and talk to the market. Dan will hand over then to Scott McRae, who will deal with the financial results, and then I'll pick up with the portfolio activity. So in that, as Alessandro said, we welcome questions, and we'll take questions at the end of the presentation. So if you want to put the questions to us through the Q&A function, that would be great. So first of all, I'll hand over to Dan, who will set the scene and talk to the market.
Thank you very much, Richard, and good morning, everybody. So just in terms of market context and starting with the capital markets, the capital markets have been fairly benign, both over the quarter and throughout the year. Volumes are down about 50% year on year. The issue that we currently have is that we've got buyers that are relatively hesitant to act with great conviction because you've still got elevated cost of capital. And on the other side, you've got sellers who are looking at the direction of travel, thinking that the market is going to move more in their favor. So as a result, there has been a bit of a mismatch between expectations that's caused values to drift a bit throughout the year. So if you look at the MSCI index, capital values are off about 2.5% over the quarter and about 5.6% over the year. But I think we've reached quite an interesting point in the market cycle now, driven effectively by interest rates. So rates look to have now peaked. We've seen gilts and swaps respond to positive inflation data, and they've moved in from about 4.9% in September to the current level of about 4%. On the other side of that, you've got the equivalent yield on UK real estate, which is now at about 7%. So that's offering a reasonable risk premium, which is going to begin to look more attractive as monetary policy loosens through the year and with rental growth still coming through. I do expect there may be some slight softening in values within certain parts of the market in the early part of the year, focused effectively on sectors and subsectors where you've got the weakest rental growth outlook. But I'm not expecting there to be material distress. Firstly, the UK has already seen some of the strongest correction in values of the major markets. We've seen values come off some 25% in the last 18 months. Also, it looks like we will hopefully avoid slipping into recession. That will support the occupational markets that are underpinning returns from real estate. And thirdly, you've got levels of gearing that are still relatively conservative, and you've got a financing environment that's easing slightly. So on that basis, I suspect we are somewhere close to the nadir of the market cycle. And if you go back to previous cycles and look at previous price corrections in the late 80s, the mid 1990s, during the GFC, and then in the early 2010s, the real estate market generated double-digit annualized returns in the 5 years following those. So it could be quite an interesting point, particularly given you've got a bit of a disparity essentially between weaker capital markets and then resilient occupier markets. So just turning to the occupational markets, income is very much driving returns at the moment. If we go back to the MSCI index, you're on an income return of 5.7 that's effectively offset falls in capital values over the year. Interestingly, at the headline level, the market is generating rental growth. It delivered 3.9% over the year, and there was positive contribution from all the sectors on a headline basis. But what we are seeing is kind of an increasing divergence in performance between subsectors and assets, driven effectively by the underlying fundamentals behind the rental growth statistics that we're seeing. So if you take industrials, for instance, it's still generating very strong growth. You can see 7.6% there. But the vacancy rate has increased by about 300 basis points over the year. So you've got to be really careful on your subsector allocations there rather than looking at kind of thematic allocations to the sector. We are favouring mid-box markets, undersupplied strategic locations like arterial routes, which will continue to support demand, and then you'll see that growth coming through. But as you can see from the vacancy stats, that growth isn't going to be uniform across the sector. That said, we are still seeing meaningful capital being raised for deployment into the sector because the occupation underpin is still very strong. There isn't great conviction buying at scale at the minute. The office sector is very well rehearsed, and it is still strongly polarised between the prime and the secondary markets. So vacancy in the prime markets is very low. If you look at somewhere like the West End, it's about 5%, and the prime stock within that will be comfortably below that level. But you need to look at the sector level vacancy of over 21% to see how acute the issue is in some of those secondary markets where you've got vacancy that gives rise to income risk, to capital expenditure, and to potential obsolescence. And that's really what's kind of precipitated the challenges in the sector. But as Rich has already alluded to, if you've got the right assets in the right location, you can generate rental growth and you can find liquidity in the investment markets, as we've been able to do over the quarter. Turning to the retail sector, as far as institutional markets go, for us, it's really focused on retail warehousing because you've got fragmentation on the high street and you've got well-documented structural challenges in shopping centres. So on retail warehousing, you've got vacancy rates at sub 5%, 3.8% according to MSCI, and that supports an attractive and sustainable income return. And at these sorts of levels of occupancy, you'd expect rental growth to be coming through because there's still a very strong and expansionary occupier base underpinning the investment thesis there. The central London retail market is obviously one that we keep a very close eye on, and it's been encouraging for St Christopher's Place to see some of the occupational stats that we've had coming out of Oxford Street. So over the course of the year, you've seen rents and business rates rebased by about 40%. And as a result, we've seen a record year for new deals. So over 200,000 square foot has been leased. You've got another 100,000 square foot under offer. And outside some of the substantial development projects that you've got on the street, vacancy rates are now very low. And that's giving rise to initial indications of potential headline rental growth coming through from the stabilised level that we've got now at about £650 Zone A. Lastly, on the alternative markets, the student and resi markets are still generating very strong rental growth, supported by strong demographic trends. I think what's been emerging a bit more in recent months is in the student markets, some concern around funding of universities and the growth rates amongst international students. But in general, the prospects in those bed sectors are still very attractive. So just very quickly on where we go from here. There are certainly still risks out there. You've got geopolitical risk. Inflation is still above target. The outlook for economic growth is fairly skimpy and financing conditions are still tight. So that's likely to maintain the current kind of stasis we've got in the investment market, certainly for the early part of this year. But the macroeconomic backdrop is becoming more supportive of capital markets. And on the other side, you've got recessionary risk to occupational markets potentially receding. And so as we progress through the year, we'd hope that those two factors combine to underpin some recovery in the sector. So that would be my summary of the current market backdrop. And with that, I'll hand over to Scott.
Thanks, Dan. For the quarter, the NAV total return was minus 2.4%, with the NAV falling by 3.6% to 109.8 pence. The share price at the end of the quarter was 72.5p, which was a total return for the quarter of 8.9%, but a discount of 34%. Pleasingly, the share price has moved further since the quarter end. It's currently trading at 77 pence per share, which is just under a discount of 30%. In terms of What's been moving the NAV? Well, the majority of the movement was down to the performance of the portfolio, with capital values down by 2.6%. The primary reason for those movements was further fall in office valuations, which were down just over 5%, and retail warehouse, which was down 4.6%. In terms of the dividend cover for the quarter, the dividend cover on an accounting basis was for the quarter was actually 88%. However, on a cash basis, it was 113%. Key point being here that we did have the sale of a couple of properties just before the end of the quarter, and under the accounting rules, we had to at that point cancel lease incentives which had been accruing to smooth rental income. I won't go any more technical than that. Turning to the annual results as part of that, the NAV total return for the year was minus 7.3%, minus 3.3%, with a NAV down 7.3%, and the share price was total return for the year was minus 12.5%. Again, the main reason for the falls is offices, which were down over 18% over the 12 months. Dividend cover for the year on a cash basis was 115.5%, and 102% on an accounting basis. I guess the other point is cash. Following the sale of 2 Scottish properties towards the end of the year, the cash on the balance sheet at the end of the quarter was 42 million. As most of you will have seen, we also sold a building at King Street, London, early January, and cash reserves at the moment are sitting at around £70 million. So those are the key highlights, and I'll hand over to you, Richard.
Thanks very much, Scott. So first of all, just picking up on the valuation moves and providing a little bit more colour on some of that movement. As Scott has said, the valuation movement at the portfolio level was minus 2.6%, and that was very much in line with the MSCI quarterly index. And we saw yields moving out across the portfolio at both the initial and equivalent yield basis by about 10 basis points. The industrial and logistics portfolio, well, that experienced a small fall in value of about 0.9%, and the equivalent yield moved out by about 14 basis points. And really, the movement there was at the sharper end of our initial yields. Our industrial logistics portfolio is very reversionary, but some of our initial yields were getting a little bit tight. So you saw some movement and expansion in the initial yields. The offices sector, as Dan said, that continues to be a very challenging sector, and the movement there was minus 5.4%. And that was driven by equivalent yields moving out 30 basis points to 8.2% overall on that segment of the portfolio. Retail warehouses, we saw robust occupational demand, and all our retail warehouses are fully let. The fall in value there, which Scott alluded to, of 4.6%, was driven by CBRE, external valuer, moving out yields by 25 basis points. So that segment of the portfolio stands at an equivalent yield of 6.2%. St Christopher's Place, that fell in value by about 1.5%, and that was due to the office and residential movements there. We've got quite a lot of churn in our office segment at St Christopher's Place, but rental values are holding up, but cap rates fell out. And just generally, just building on what Dan said about the Oxford Street market, we are seeing St Christopher's Place continue to recover. We're repositioning where we can the asset away from retail to more food and beverage, we have completed a number of lettings in the recent past, and we have a strong pipeline of restaurants and F&B interest in St Christopher's Place. So we're currently working on 3 or 4 important lettings on the estate, which will really support the bounce back in the performance of St Christopher's Place. So moving on to the portfolio and an update on some of our key strategic objectives. We flagged in previous announcements and calls that we were embarking upon a selective disposal strategy to reduce our office exposure and to recycle capital. Now, we had a really positive outcome, and we've announced the sale of 3 assets, raising in total sale proceeds of 42.8 million. I think the fact that we sold those assets at a 0.3% discount to the September 2023 independent valuation speaks to the quality of the assets. And these sales now reduce the office exposure to 24.4%. So the first of the sales was 2-4 King Street. That's a London freehold property. We sold that to a high net worth individual, family office overseas. All the money was overseas that considered 2-4 King Street. We had about 27 inspections. We sold that for 28.465 million, which was an initial yield of 4%. So not really accretive to the portfolio, given the dividend, and that reflected a capital value of £2,000 a square foot. The second property we sold was a headquarters office building on Edinburgh Park. This is in an out-of-town location. It's a really good quality building, but out-of-town offices are certainly not flavour of the month, as Dan alluded to, and there is considerable vacancy on Edinburgh Park. So, it's quite a challenge market, and we were pleased to contract the sale of that. And the third asset was another out-of-town office building in Aberdeen, which is let to Maersk, and it's a bit of a hybrid building. It's part offices and a part training facility. So a bit of a quirky building, but I have a really positive outcome there to achieve those 3 sales. I think the market has reacted positively to those sales, and as Scott said, we have seen some improvement in the share price in recent weeks. Now, we are continuing to dispose of office properties. We are certainly not a forced seller or a motivated seller, so the process is being well managed, and we're hopeful of making further announcements on those sales in the coming weeks. I thought at this stage we'd put in a bridge on our income growth within the portfolio. So this is a good slide that demonstrates the day one reversion within the portfolio. You can see here the passing rent, the amount of rent that we've got in rent-free periods, and the void and development reversions that are coming through on the portfolio. So the portfolio grew by 1.2% over the quarter and 6.5% over the last 12 months. And what this bridge shows is that there's a day one reversion in the portfolio of around about 16%. The development ERV there is mainly driven by and underpinned by the refurbishment of 2 units in Southampton, which have since been committed to new tenants. So that's fantastic news, and I'll come on to that in a minute. And then specifically with the void, you can see there we've about void ERV of 4.63 million. The majority of that void is attributable to Stockley Park, Uxbridge, which is a vacant office building, which we are seeking to reposition into a medical use. And hopefully we'll be submitting a planning application to the local authority next week. So there's very much a strong initiative and a priority to reposition that asset via a planning application and a satisfactory outcome to that planning application. Within the portfolio itself, we've got about 31% of the income, which has contractual uplifts, which are either subject to index-linked rent reviews, which account for about 8.8%, or to fixed uplifts. And that's not captured in that day one reversion. So I think the income story is positive there. And as I say, a 16% reversion in the portfolio that the team and I need to exploit and deliver over the coming months and the next couple of years. With regards to the activity in the portfolio, then we were delighted to complete the substantial refurbishment of Strategic Park, Southampton. These are 2 logistics properties which became vacant in the autumn of 2022 and have been subject to a comprehensive refurbishment. We've really improved the ESG credentials on these properties with EPC A ratings, a BREEAM very good standard, and really that stood us in very good position to pre-let these units, and both units have been committed to. One of the lettings is subject to a widening of the planning use, which we're hopeful of achieving by the early part of March. The rental uplift on these units as a result of refurbishment is about 27.5% ahead of the previous rent passing, and the capital uplift has been around about 16%. And interestingly enough, one of the major initiatives on the refurbishment there was the installation of a comprehensive PV solar scheme, which both tenants have signed up and contracted to taking the electricity which is generated from those PV panels. And that solar scheme really assisted in the leasing of these units and should throw off a cash flow around a return of around about 7.5%. And within the portfolio, we've got other opportunities that we're looking at to install solar schemes at various properties. In Birchin Lane, we've been undertaking a comprehensive refurbishment of a number of floors in this building as well, with a strategy really on our plug and play activities. So providing some form of fitted out offices to the tenant. We let the vacant first floor here at around about 17.5% above the pre-refurbished ERV. We've got a vacant unit on the ground floor, and there's a good level of tenant interest in that. So, in central London, we are seeing office leasing activity. One of our Mayfair properties, where we have a vacant floor, that is now under offer at a rent way north of £100 a square foot, which is significantly ahead of pro forma ERVs. Then the Cowdrey Centre, Colchester, there's been a lot of activity on this multi-let estate. It has a number of staggered lease events that we're managing throughout the portfolio, and some refurbishment and development opportunities on the estate as well. So you can see here that there were lease renewals undertaken that substantially increased the rent passing, and one of the big deals here was a lease renewal with Range, who occupy units as a retail unit, and they entered into a new 15-year lease at a 9% premium to the ERV. So a lot of activity on that estate. So overall, Q4 last year was a very much a active, positive positioning in the portfolio. We saw recycling of assets and a lot of activity in the portfolio, and we continue to see activity. It's fair to say, and I reiterate what Dan said, the occupational markets continue to be robust, and we haven't got a high void rate within the portfolio, and we're managing our voids. The priority is the large void that we have at Stockley Park, and as I say, we're well progressed there with submitting a planning application to the local authority, who in all the pre-application meetings that we've had with them have been supportive to the repositioning and the change of use. So just quickly, why invest in Balanced Commercial Property Trust? Well, I think as we demonstrate, we've got a balanced portfolio of high quality assets. We've got an income-led total return strategy that's coming through in the reversion, and especially the reversion that is in the industrial and logistics sector. We always actively manage the portfolio. There's a lot of latent potential within the portfolio to exploit value. And as we can demonstrate, we have a responsible and sustainable approach to ESG. We improved our GREB scores last year, and we have an internal target to incrementally increase year on year our GREB score. But it's not all about the sort of the regulation and the reporting of ESG. It's also about the interventions that we make in the portfolio. And as I say, one of the real focus of activities during the course of last year and moving into this year is the rollout and the feasibility and understanding of where we can install PV solar panels. So really, that's a summary of the Q4 activity, the Q4 movements in value, and that completes the formal presentation. So I think this is the part of the presentation that we now hand over to you for Q&A.
Perfect. Richard, Daniel, Scott, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received some questions throughout today's presentation. And Christine, at this point, if I could hand over to you just to chair the Q&A, that'd be great. And then I'll pick up from you at the end.
Perfect. Thanks very much. Yeah, we've got a good few very interesting questions. So I'll kick off with one, which is about the offices. I'd say that's high on everybody's radar to hear more about. How much further do you expect to reduce your office exposure in the portfolio, given the high equivalent yields? And then I'll follow up with a kind of more detailed question after that about future office disposals as well.
Well, as I said, Christine, we've got a strategy to reduce our office exposure. So we've currently got a number of our offices selectively on the market. So we will be seeking to reduce our office exposure to well under 20% of the portfolio.
Okay, very clear. Thanks. So if you don't mind, I'll read out this quite detailed question. In terms of future office disposals, is there a trade-off between disposing of the more prime, well-located buildings, and they've mentioned Birchin Lane or King Street, where recently completed asset management should underpin more resilient occupancy and values going forward, versus disposing of the more challenged out-of-town offices near Aberdeen or Edinburgh, where values are likely to come under further pressure going forward? So is it simply a case that assets in better locations are more liquid and easier to sell? And how do you kind of balance that?
So certainly, I mean that's a very good question. So yes, I mean the central London assets are more liquid than out of town regional office locations, and that's underpinned, as I said, by really the demand from ultra high net worth individuals and family offices that are seeking wealth protection in central London. So King Street, as I referenced, we sold at 4% yield, £2,000 a square foot. And that again is an asset where we have completed our business plan. It has been fully refurbished. It's been let at high rent. So it's wholly appropriate to recycle the capital from that asset. Now, moving forward, yes, we also want to sell and reduce our exposure to regional office market. So we had the success in Aberdeen and Edinburgh, but we are also looking to dispose of other regional assets. So it is a balance, and it needs to be managed. But I was delighted to be able to demonstrate in the first announcement that we were selling a more liquid central London asset, but we were also selling 2 regional assets that were more challenged in out of town locations.
Thanks for that. And maybe just keeping in that out of town locations, and actually I'm not sure if Canary Wharf qualifies as that, because there's been a question just quoting a headline that was in the press recently asking if this is a sign of things to come. It says a 12-storey tower in Canary Wharf at 5 Churchill Place was reportedly sold for 60% less than its 2017 purchase price. Would you comment on that at all? Is that similar to what you're seeing in any other kind of out of office or out of city offices?
I mean, I've no exposure to Canary Wharf within the portfolio, or as a house either. So I would comment that obviously Canary Wharf is challenged at the moment, given the massive lot sizes of those properties, the actual massing, the scale of those properties in that location, and some of the capex that is required to refurbish those properties and to improve their ESG standards. So I think the values have fallen there. There's been motivated sellers due to high levels of debt in those buildings and refinancing pressures. So yes, you've seen properties trade at significant discounts to their purchase price a few years ago. Within our portfolio, we're not experiencing those such significant write-downs as that example.
Yeah, that's great to hear, just to kind of re-emphasize the quality of your existing portfolio. And maybe just to touch on the ESG point that you just made there, there's a question about could the additional income resulting from the solar panel installation at Strategic Park in Southampton be replicated in other properties in the portfolio?
Yes, we are looking at that, Christine. So we're looking at a number of projects, and they're in various stages of development. But I think across the portfolio, we've got about 14 or 15 active discussions with tenants, as I say, at various stages. About installing PV solar panels, so it's very much a priority for the company.
Great.
And something that the board is fully supportive of.
Yeah, nice. There's a couple of questions about refinancing and the debt, so maybe Scott might want to come in on this. So one is, when do you expect to refinance the LNG term loan? There was one other one as well. Oh, apologies, I've lost it now. We'll just start on that one, please.
Yeah, thanks, Christine. Well, in terms of the LNG loan, we already have entered into a new facility, which happened last September, with a combination of Barclays and HSBC. That's a £320 million facility, £60 million of which is a revolving credit facility. But there is also a term loan commitment for £260 million, which can only be used to refinance the LNG loan. So we already have a provision in place to actually deal with that. I guess a further point that is worth making on that is that the likelihood is, I mean, one of the, we obviously are generating some cash, and the board are considering the appropriate level of borrowings going forward in a higher interest rate environment. And I would suggest the likelihood of us using the full 260 million Barclays HSBC facility is low. So I think moving forward, we would look to use that facility in the short term in the hope that interest rates improve. But we do have the provision to cover the LNG position.
That's great, because it actually answers two other questions that were very similar. Thanks so much. So then there's a question about, and they thank Richard and Dan explicitly as well. Please, could you provide some more detail around the asset at Stockley Park? Are you looking to undertake the refit yourselves? Is there an interested tenant in place? Are you able to provide any estimates on timescales from planning submission to refit?
Well, that's a lot of questions. On Stockley Park, we have we do have a tenant that we are discussing the asset with, and that tenant actually will be named on the planning application and has attended the pre-application meetings with the London Borough of Hillingdon. And we're currently in advanced discussions about leasing that building to that tenant. With regard to timing, then, as I said, we will be in a position to hopefully submit a planning application next week. And then we will be in the process really with the London Borough of Hillingdon, and I would hopefully expect a planning decision probably around May time this year. Mm-hmm. So in the meantime, we'll be working up heads with the prospective occupier that we've got, and then we'll be making a decision on the implementation of strategy, really.
Great. Then there's been a question as well about leasehold reforms. Somebody's asked if you are worried about them.
Within the portfolio, no.
Okay. So
No, we've got very, very little leasehold interest within the portfolio.
Okay. Then there's actually a question about discounts and how BCPT compares to peers. Would anybody like to comment there? Actually, like even just from our perspective on the sales team, we have seen it tighten in the last few weeks, so that's been quite positive. And obviously the broker has been very active in that there's been a lot of new buyers as well as existing shareholders topping up, and that seems to be helping a lot. But maybe if anybody else wants to comment.
I mean, we've had a very busy January with a number of shareholder meetings, Christine, and as you said, that has resulted in several new shareholders in BCPT and some buying activity. And recently we've seen an improvement in the share price. I think that's due to improving macros, as Dan discussed, and I think also the activity within the portfolio and the announcement of the completion of those office sales has been well received by the market. And I think there's greater understanding as to the refinancing that the company undertook last year, and the optionality that we have around that refinancing.
Yeah, exactly. I think we're coming to the end of the questions, I believe, but there's one kind of picking up on what Dan was alluding to as well about in the market context. If there's limited market transactional volume, how much of this is a mismatch between buyers and sellers' expectations? And then they're asking about valuers. Should they be marking down valuations faster just to get things kind of over with?
Rich. Yeah, I think firstly on the valuation piece, I mean, as I said, the UK valuers have actually moved values on quickly and sharply, as there was some unwelcome volatility 12 months ago, and it's continued to drift out. So I think the valuers have adjusted. I can't speak to other companies, but obviously, as Rich has mentioned, we've been selling at NAV near enough, and those weren't sales kind of around a premeditated valuation. So I mean, those valuations came out before we put those assets on the market. And to the point on transaction volumes, I think really it's macro led at the moment rather than anything else. You've just got, there has been uncertainty around the direction of travel until the more recent months, and so that's really what's been behind the stasis from the buying side, because they've been thinking about cost of capital. So I think really it has been macro led decision making rather than anything else.
Mm-hmm. That's very helpful. Thanks, Dan. Then just the last question that seems to have come in the last few minutes. Oh, and another one, apologies. One is, has a date been set for the continuation vote, and what are the permutations around that? Richard, would you like to comment if you can?
Certainly, well, the board is very much considering the continuation vote and the strategy around that, and will be making further announcements and communications to shareholders in the near future.
Great. Then there's one asking about if the difficult market conditions are actually presenting opportunities to add seriously undervalued assets to the portfolio.
So to take advantage of this distress in the market.
Yeah.
Okay. Yeah, I mean, we're obviously monitoring the market, looking at deals, and we want to complete our own strategic sales, and then we'll be discussing with the board the optionality and the use of that cash.
Mm-hmm. Great, yeah, and you've made a few comments in terms of that as well previously. So we can wrap up there. Richard, would you like to just add any closing comments for the audience to take away?
I mean, my closing comments really was just reiterating that it's was very positive on the 3 sales that we completed. 2 of which were out-of-town regional offices. So it's not a case of we're selling the more liquid assets first. So I think that's really good progress and has been well received by the market. And then within the portfolio itself, just reiterate the value that we've got within the portfolio in the asset management that we've got ongoing at the moment. And in the pipeline, and the reversion within the portfolio that we will be exploiting over the short term.
Perfect, Richard.
A lot of opportunity within the portfolio.
Perfect, Richard, Daniel, Scott, Christine, thank you all for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Balance Commercial Property Trust Limited, we'd like to thank you for attending today's presentation, and good morning to you all.